At first glance, it doesn't look like collapse. The skyline still glows. Glass towers still catch the desert sun. Luxury cars still glide through wide, immaculate roads as if nothing has changed. From a distance, Dubai remains what it has always promised to be, a symbol of limitless ambition, engineered wealth, and a future built ahead of schedule. But look closer. Behind the polished surfaces, something quieter is unfolding. Construction sites that once operated around the clock are slowing. High-end developments are being quietly restructured. Investors are asking different questions now, not about growth, but about sustainability. And at the center of it all lies a project worth $3.5 billion. A project that was supposed to redefine luxury living. A project that now raises a more uncomfortable possibility. What happens when a city built on perpetual expansion begins to encounter its limits? Because this isn't just about one failed development. It's about a system that may no longer function the way it once did. And to understand that system, we have to go back to how it was built in the first place. Dubai was never meant to follow a conventional economic path. Unlike most global cities, it didn't emerge from industrialization, nor did it rely heavily on natural resources in the long term. Oil played a role in its early development, but even at its peak, it accounted for a surprisingly small portion of the Emirates' GDP. Instead, Dubai engineered something far more unusual, a growth model built on real estate, global capital flows, and perpetual reinvention. From the early 2000s onward, the formula was deceptively simple. Attract foreign investment, build faster than demand, sell the future before it arrives. Megaprojects became the backbone of this strategy. Artificial islands, record-breaking skyscrapers, entire districts constructed almost overnight. Developments weren't just properties. They were narratives. Each one promised exclusivity, innovation, and a lifestyle that existed slightly ahead of reality. And for a time, it worked. Between 2002 and 2008, Dubai's property prices surged by more than 70%. Foreign ownership laws were relaxed, opening the floodgates to international buyers. Capital poured in from Europe, Russia, India, and beyond. The city became a global hub not just for tourism, but for speculative investment. But beneath that rapid expansion was a structural dependency. Dubai's economy became deeply tied to continuous inflows of external capital. Real estate wasn't just a sector, it was the engine. And like any engine, it required constant fuel. When the 2008 global financial crisis hit, that dependency was exposed almost instantly. Property prices fell by nearly 50%. Projects were halted mid-construction. Developers faced liquidity crises. Dubai required a $20 billion bailout from Abu Dhabi to stabilize its financial system. For a moment, the illusion of unstoppable growth cracked. Yet the recovery came. And it came fast. By the mid-2000s, confidence had returned. New projects were announced, even larger than before. Expo 2020 was positioned as a catalyst for another wave of expansion. Once again, the narrative shifted from crisis to opportunity. But something had changed. This time, growth was less organic. Developers began offering extended payment plans, post-handover financing, and incentives designed to sustain demand. Supply continued to rise, often outpacing population growth. Vacancy rates quietly increased, even as new developments were launched. By 2019, signs of strain were already visible. Property prices had been declining for 5 consecutive years. Rental yields were compressing. Analysts began warning about oversupply, particularly in the luxury segment. Yet construction didn't slow down. In many cases, it accelerated. Then came the pandemic. At first, it seemed like another existential shock. Tourism collapsed. Flight routes were suspended. The global economy contracted. But in a surprising twist, Dubai rebounded again, this time fueled by a different kind of capital. Remote workers, high net worth individuals, crypto wealth. Between 2021 and 2023, property prices surged once more, particularly in ultra-luxury segments. Villas on Palm Jumeirah sold for record-breaking amounts. Branded residences became the new frontier of speculative investment. But beneath this resurgence, the structural dynamics remained unchanged. Supply continued to expand aggressively. Megaprojects returned, each one more ambitious than the last. Among them was a development valued at $3.5 billion, designed not just as a residential complex, but as a statement of continued dominance in global real estate, a symbol that Dubai's model still worked. Yet today, that same project is being quietly reevaluated. Delays, financial restructuring, shifting investor sentiment. Not enough to trigger headlines, but enough to raise a deeper question. If growth in Dubai depends on constant expansion, what happens when expansion itself becomes the risk? To understand that, we need to step away from the skyline and look at the individuals living inside it. In a one-bedroom apartment overlooking a half-finished waterfront, Daniel refreshes a property app for the third time that morning. The listing hasn't changed. Same price, same photos, same silence. 2 years ago, this unit felt like a calculated move. Daniel wasn't a speculator in the traditional sense. He worked in compliance for a multinational firm, relocated to Dubai during the post-pandemic surge. The city at the time felt like momentum made visible, a place where capital moved quickly and decisions seemed to pay off. The apartment was part of a larger development tied to that $3.5 billion project. It promised integrated living. Retail below. Leisure spaces above. A curated environment designed to eliminate friction and maximize value. The sales pitch was precise. Buy early. Benefit from appreciation. Exit before completion if needed. Daniel didn't see it as risk. He saw it as timing. The payment plan made it easier. Only 40% upfront. The rest staggered across construction milestones. By the time handover arrived, the assumption was simple. The market would be higher, liquidity would be available, and options would exist. For a while, that assumption held. Prices in the surrounding area climbed steadily through 2022. Similar units were reselling at premiums. Agents called regularly, suggesting he could flip early. There was always another buyer, another wave of demand entering the system. But Daniel waited, not out of conviction, but because waiting felt safer than exiting too soon. Then, something shifted. It wasn't dramatic. No crash. No sudden drop. Just bumps and friction. Listings started sitting longer. Agents became less certain. Offers, when they came, were below expectations, not significantly lower, just enough to introduce hesitation, enough to break the rhythm of easy transactions. At the same time, construction timelines began to stretch. Updates from the developer became less frequent. Completion dates were adjusted, subtly at first, then more visibly. What had once been marketed as a seamless delivery started to feel conditional. Daniel recalculated. The longer the delay, the longer his capital remained locked. The exit window, once assumed to be flexible, began to narrow. Meanwhile, new projects continued to launch nearby, many offering more aggressive payment terms, more supply. Same pool of buyers. The math wasn't catastrophic. But it was changing. By early 2025, Comparable units in nearby developments were being listed at prices nearly identical to Daniel's original purchase. After fees, commissions, and currency fluctuations, the margin had effectively disappeared. He wasn't losing money. Not yet. But he wasn't gaining it either. And in a system built on forward momentum, stagnation carries its own kind of pressure. Daniel began noticing smaller details. Empty units in adjacent buildings, lights off at night in what were supposed to be fully occupied towers, promotional banners offering guaranteed returns, something that hadn't been necessary during peak demand. Even conversations changed. Colleagues who once discussed new investments began talking about exits, not urgently, but cautiously. The tone shifted from expansion to preservation. For Daniel, the uncertainty wasn't just financial, it was temporal. Every delay extended exposure. Every new project diluted demand. Every quiet adjustment in the market forced a reassessment of assumptions that once felt stable. He considered renting the unit after completion, but rental yields had compressed. Supply in the area suggested competition would be high. The numbers worked, technically, but without the buffer he had expected. The system hadn't failed. It had slowed. And in slowing, it revealed something less visible during periods of growth: how dependent individual outcomes were on collective momentum. Daniel's situation isn't unique. Across Dubai, thousands of similar positions exist. Investors tied into payment plans, waiting for completion, navigating a market where timing matters more than fundamentals. Each one making small decisions based on incomplete information. Each one assuming that the broader system will continue to function as it always has. But systems like this don't need to collapse to create pressure. They only need to stop accelerating. Because when growth becomes expectation rather than outcome, even stability can feel like loss. And when enough individuals begin to feel that shift at the same time, the impact extends beyond any single project. It starts to reshape the system itself, which raises a more structural question. What exactly is this system built on? And how resilient is it when the conditions that sustained it begin to change? To understand the pressure building beneath Dubai's surface, it's necessary to step back from individual experiences and examine the architecture of the system itself. Because what appears as a collection of isolated developments is, in reality, a tightly interconnected financial structure, one where real estate, liquidity, and confidence are continuously reinforcing each other. At its core, Dubai's model depends on velocity. Capital enters the system through foreign buyers, often attracted by tax advantages, residency incentives, and the promise of asset appreciation. That capital is then absorbed into off-plan developments, projects sold before completion, sometimes years in advance. This is where the mechanism becomes self-sustaining. Developers use incoming payments from new buyers to finance ongoing construction. In parallel, rising prices create the perception of value, which attracts more buyers, which in turn sustains construction. The system doesn't rely solely on end users. It relies heavily on investors entering and exiting at different stages. Liquidity, in this context, is not just beneficial. It is essential. As long as units can be resold before completion, risk appears manageable. Buyers are not necessarily committing to long-term ownership. They are participating in a cycle. The ability to exit becomes just as important as the decision to enter. But this structure introduces a subtle fragility. Because liquidity is not guaranteed, it is conditional. It depends on a continuous inflow of new participants willing to absorb existing positions. When that inflow slows, even slightly, the entire chain begins to adjust, not collapse. Adjust. Fewer buyers mean longer holding periods. Longer holding periods mean capital remains locked. Locked capital reduces flexibility, and reduced flexibility changes behavior. Investors become more cautious. Developers respond with incentives. Payment plans stretch further. Marketing intensifies. New projects are positioned as better opportunities than existing ones, which creates a paradox. In order to sustain demand, the system increases supply. Over time, this leads to a layering effect. Multiple generations of projects competing simultaneously for attention, capital, and occupancy. Some are completed. Others are delayed. Many overlap. From a distance, it still looks like growth. But internally, competition intensifies. The $3.5 billion project sits within this exact dynamic. It was conceived during a period of renewed confidence when capital inflows were strong and demand appeared resilient. Its scale was not unusual by Dubai standards, but its timing placed it into an increasingly crowded pipeline. As newer developments emerged with more flexible terms, earlier projects faced a quiet form of displacement, not cancellation, but deprioritization. Buyers evaluating options began comparing not just location or design, but financial structure. A project offering lower upfront commitment, longer payment horizons, or post-handover financing becomes inherently more attractive in a slowing market. This shifts the competitive landscape in subtle ways. Older projects, even if fundamentally sound, become less liquid. Resale markets thin out. Price discovery becomes less transparent. Transactions still occur, but with more negotiation, more delay, and less certainty. At the same time, developers face their own constraints. Construction costs fluctuate. Financing conditions tighten. Timelines extend. Each delay introduces additional exposure, not just for the developer, but for every buyer tied into the project. And because many of these projects are interconnected through shared contractors, financing channels, and investor pools, pressure in one area can propagate across others. This is where the system reveals its deeper characteristic. It is not static. It is reflexive. Perception influences behavior. Behavior influences outcomes. Outcomes reshape perception. When prices are rising, confidence expands. When transactions slow, even without significant price drops, confidence begins to recalibrate. In Dubai, where a significant portion of demand is investor-driven rather than occupancy-driven, this recalibration happens quickly, but often quietly. There are no immediate signals, no single moment that defines a shift. Instead, it appears as a series of small adjustments. Units taking longer to sell, developers offering additional incentives, investors holding positions longer than planned. Completion dates moving incrementally. Each change, on its own, is manageable. Together, they alter the system's rhythm. And rhythm matters. Because Dubai's model was not designed for stagnation. It was designed for movement, continuous, forward, accelerating movement. When that movement slows, even without reversing, structural tension begins to accumulate. Not as a visible crisis, but as a series of constraints. Constraints on liquidity, constraints on timing, constraints on expectations. And over time, those constraints begin to shape behavior in ways that are difficult to reverse. Investors become more selective. Developers become more aggressive. Projects become more complex. The system adapts, but adaptation introduces new variables, new dependencies, and new risks, which leads to a final, less visible layer of impact. Because beyond capital flows and construction timelines, there is another dimension that determines whether a system like this can sustain itself. Not financial, but psychological. And once that layer begins to shift, the effects are no longer contained within balance sheets or project pipelines. They begin to affect how people perceive the future itself. And that is where the pressure becomes something else entirely. At a certain point, the numbers stop being the primary concern. Not because they no longer matter, but because they no longer provide clarity. In a system built on forward projections, confidence is not derived from current conditions. It is derived from expectations about what comes next. As long as the future appears predictable, uncertainty feels manageable. But when timelines stretch and outcomes become less defined, something more subtle begins to shift. Investors don't panic. They hesitate, and hesitation, in a system dependent on momentum, carries its own weight. Daniel notices it in small ways. Conversations that once moved quickly now pause. Decisions that used to feel obvious now require justification. The language changes, from when to if, from next opportunity to current exposure. There is no clear moment of realization, only a gradual awareness that the system is no longer behaving in the way it once did. This creates a form of cognitive dissonance, because externally, very little appears different. The skyline remains intact. New projects continue to launch. Official narratives emphasize resilience, growth, and long-term vision. But internally, expectations begin to decouple from reality. And when that gap widens, individuals are forced to reconcile two competing perspectives, what they see and what they feel. For many, the response is not immediate action. It is delay. Holding longer. Waiting for clearer signals. Avoiding decisions that would force a realization of loss, even if that loss is only relative to expectations. This behavior is not irrational. It is adaptive. But when replicated across thousands of participants, it produces systemic effects. Transactions slow. Liquidity tightens. Price discovery becomes more opaque. Markets begin to move less through decisive shifts and more through prolonged uncertainty. In this environment, even stability feels unstable. Because without clear upward movement, the underlying assumptions that justified entry begin to erode. And once those assumptions weaken, the narrative that sustained the system becomes harder to maintain. This is where escalation takes a different form. Not through sudden collapse, but through accumulated tension. Developers respond by increasing incentives, extended payment plans, fee waivers, guaranteed returns. These measures are designed to restore confidence, to reintroduce momentum. But they also signal something else. That demand, in its natural state, is no longer sufficient. Investors, in turn, become more analytical. They compare options more carefully. They question timelines. They reassess risk not just in terms of price, but in terms of liquidity, the ability to exit when needed. The system doesn't stop. It becomes more complex, more conditional, more dependent on maintaining a balance between perception and reality. And within that balance, a new kind of pressure emerges, one that is harder to quantify. Because it exists not in the assets themselves, but in the expectations surrounding them. A pressure that builds slowly, often invisibly, until it reaches a point where even small disruptions can have disproportionate effects. Which leads to a final question. Not about whether the system will fail, but about what it becomes when it can no longer rely on the assumptions that once sustained it. Cities like Dubai, are often described as visions made real, places where ambition overrides limitation, where scale becomes proof of possibility, where the future feels not just imagined, but already constructed. And in many ways, that vision still holds. The infrastructure exists. The skyline remains. Capital continues to flow, even if more selectively. There is no definitive moment where the system breaks, no single event that marks an ending. But systems don't need to collapse to change. They only need to lose the conditions that once made them predictable. What made Dubai's model powerful was not just growth, it was the expectation of growth. The assumption that expansion could continue indefinitely, supported by a constant renewal of demand, capital, and confidence. That assumption is now being tested, not through crisis, but through friction. Through delays that stretch timelines, through supply that outpaces absorption, through individuals like Daniel, quietly recalculating positions that once felt certain. The $3.5 billion project is not an anomaly. It is a signal. Not that the system is ending, but that it may be entering a different phase, one where momentum is no longer guaranteed, and where outcomes depend less on scale and more on balance. And in that shift, the question is no longer how high the city can build, but how long it can sustain the forces that built it in the first place.